So, India's central bank just cut interest rates, and believe me, this is a much bigger deal than it sounds. In this explainer, we're going to break down exactly what this move means for the economy, which industries are really set to benefit, and of course, what it could mean for your money.
It really all boils down to this one simple but super powerful question. Because for millions of people all across the country who have a loan, this isn't just some hypothetical. It's exactly what just happened.
Okay, so here's the magic number. On December 5th, 2025, the Reserve Bank of India cut its key interest rate, the repo rate, by 0.25%, or 25 basis points if you want to use the finance jargon. Now, this is the rate the central bank lends to commercial banks, so any change here creates this massive ripple effect across the entire financial system.
And this is where it gets real, right? This is the actual real-world impact. Just look at that highlighted row. For a 50 lakh rupee home loan, this one little cut saves you over 775 rupees every single month. That adds up to almost 10,000 rupees a year. Just poof, back in your pocket.
All right, so that begs the question, right? Why now? What is the big picture here that made the RBI pull the trigger at this exact moment? The first thing to get is that this didn't just happen out of the blue. As you can see on this timeline, it's actually the fourth rate cut of 2025. The repo rate has been steadily dropping from 6.50% back in February all the way down to 5.25% today. That's a total cut of 1.25% in less than a year, which is a huge move and sends a really strong signal. So, why is the RBI so comfortable doing this? Well, it's because the economy is in this kind of perfect sweet spot. Think of it like the perfect economic cocktail. On one side, you've got inflation at an all-time low, just 0.25%. And on the other, you have the economy projected to grow at a super strong 7.3%. It's really the ideal setup to make money cheaper and add even more fuel to that growth.
So when money gets cheaper, where does it all go? Let's follow that ripple effect and see which sectors are really set to win big from this.
And it paints a pretty clear picture, honestly. First up, the banking sector. It's a no-brainer. Their cost of funds goes down and demand for loans goes up. Then you've got financial services, especially companies in housing and consumer loans. They get a direct shot in the arm. And finally, infrastructure companies, because all those massive nation-building projects suddenly become a lot cheaper to finance.
This right here, this is the engine behind the whole thing. It really breaks it down for you. The RBI lowers the repo rate, which makes it cheaper for the big banks to borrow money. Then they can pass those savings on to us, to you and me, for things like home loans, car loans, you name it. That's what's driving this whole opportunity.
All right, let's zoom in a bit. It's one thing to talk about big sectors, but how does this actually translate into specific companies you can look at? We're going to put a spotlight on one company from each of those three winning sectors. First up, in banking, we have ICICI Bank, a real leader in the private sector. And what really makes them stand out? Look at their asset quality. Their net non-performing assets, which are basically just bad loans, are incredibly low at just 0.44%. That strength, paired with a solid growth outlook, is why you see that consensus target price of 1,630 rupees. Next, in financial services, we've got LIC Housing Finance. This is a direct bet on the housing boom. It's India's largest housing finance company, so it's a very clear winner when home loans get cheaper. But here's the kicker, the number you really need to see on this slide. Its price-to-earnings ratio is just 5.48. Now, a low PE like that often suggests the stock might be undervalued, what the pros call a deep value opportunity. And finally, for our infrastructure pick, we have the absolute powerhouse, Larsen & Toubro, or L&T. With lower interest rates, it's just that much easier to fund the projects in their mind-boggling 4 trillion rupee order book. I mean, we're talking about everything from metros to brand new data centers. That's the engine driving it towards that 4,400 rupee target. Okay, so this chart does a fantastic job of putting it all into perspective. It gives you a great snapshot of the different kinds of investments we're talking about. On the far left, you've got LIC Housing Finance with that super low PE ratio. That's your classic value play. In the middle, there's ICICI Bank, which you could call growth at a reasonable price. And then on the right, you have L&T, which has a premium valuation because investors are willing to pay up for its market dominance and massive growth pipeline.
All right, so we've got the big picture, we've got a few specific company ideas. Now what? How do you actually put this all together into a smart strategy? And maybe more importantly, how do you think about the risks involved?
So here's one possible game plan, just to give you an idea. This sample portfolio puts the biggest chunk in banking, since that's the most direct beneficiary. Then it's followed by financial services and infrastructure.
And, super important, notice that 10% in cash. That's your dry powder, right? It's money you keep on the sidelines, ready to jump on opportunities if the market takes a dip.
Now, this is absolutely crucial. The idea here is not to just jump in with both feet. Instead, this lays out a really disciplined, phased approach. You build your main positions gradually, you can add to them when new company updates come out, and then you review and rebalance every quarter to make sure you stay on track.
And if there's one thing to really let sink in, it's this. This rate cut isn't some desperate move to save a struggling economy. No, it's like pouring high-octane fuel into an engine that's already humming along at over 7%. But of course, we have to be smart about this. No opportunity comes without risk. So these are the big things to keep on your radar. A weakening rupee, any uncertainty in global trade, the small chance that inflation could surprise us and pop back up, and of course, any geopolitical tensions that could mess with oil prices. These are the things to watch. So, we'll leave you with this final thought. The RBI's rate cut is the spark, it's the catalyst. But the real story here is the powerful economic growth that it's designed to unleash. And the key for any investor is seeing this not as the end of the story, but as the beginning of a whole new chapter for the Indian economy. Thanks for joining us.